Hello friends, welcome to Scientific Investing YouTube channel, and I hope all of you are safe along with your family. Last few weeks, in fact months, have been challenging, and in fact that was also one reason why I have not been able to post new videos because I was also occupied with some of these challenges. And during that time, before all this happened, I had posted a video on one of the companies called Maithan where there were two parts of the videos, and I posted the first part. And the second part was regarding the valuation and the risk and other stuffs. And it got a little bit delayed because of this COVID, and I had promised to release this video yesterday, but again there was one day of delay. But finally, we have the second part of Maithan where we will go in detail about its valuation, about its risk. So now, without losing further time, let's jump to Maithan valuation. So in the first part of the video on Maithan we have already seen the about the company, about company's business model. We went through the financial analysis of the company. We went through the business analysis. We tried to look through last 8 or 10 years of annual reports, snippets out of it, the key strengths of the company, the kind of industry they operate, and all of you have seen in the first video. And in case you are watching this video for the first time and you haven't seen the Maithan part 1, the link is given below in the description, and you can go and you can watch part 1 and then again come back to part 2. So let us start next section, which is on valuation analysis. Now, when we look at the Maithan valuation, uh, the typically whenever we start with the valuation, we think of the standard metric like P ratio or price to book ratio or EV/EBITDA. And I will not get into detail of these metric. Maybe if required, we can discuss these metric in some other session. But P to book value, EV/EBITDA, market cap to sales, EV to sales, these are the typical ratios by which we try to evaluate a company. And I try to do similar kind of analysis in Maithan. And if we look from that perspective, my initial view is the standard metric, it fails to explain right way to evaluate this company. One reason being this company is in a cyclic industry, and usually you hear that buy the in cycling industry, buy the company at highest P, sell at lowest P. I believe many of that stuff also doesn't work, and I will show you through some of the I will show you through the data itself. And if typically, let's say if we start with a metric called P, so this is the band of P in which the stock has operated in last 10 years, where the minimum P has been 2.6, the maximum P has been 10. And I have not taken a day-to-day P level. I have taken an annual P level on 31st of March of every year. And the average P has been around 6. And then what is the current P and how much discount the current P is. But let me show you. So this is 1 year 2014. Then this is 1 year 2018, and this is like the current time. If you see the data in January 2014, the stock was at highest P, and by cyclic nature of the business at highest P, we should buy. And if you see, this is the time which is around 2014, and basically this is March data. This is renamed as January for Excel charting simplicity. But if you would have invested in March 2014, actually you would have made a lot of money because the stock just kept going up. But let us say if you did the same in 2018 March, when again the stock was almost at its one of the highest peak, but that was when the stock already met bottom, and then the stock didn't make money, it kept correcting. So just to say that buy at highest P may or may not work, and we have one example where it has worked and one example when it does not work. So after P, let us try to take much more simplistic example, because with P companies in cyclic industry, the EPS changes a lot, and hence it may not be the right metric. So let us go with something simpler, which could be a market cap to sales or EV to sales, where sales is relatively more consistent, though even in a cyclic company, the sales will decrease. And more than market cap to sales, I'm more inclined to EV to sales because it takes care of debt and all the other things. So now if we look at EV to sales, this yellow line is EV to sales, and the lowest EV to sales has been zero point 0.2, highest 1, current value is 0.9, average is 0.5. And if we see on a EV to sales basis, we will see there are 2 years. 1 year is this March 2017, and another year is March 2018. And the EV to sales in these 2 years have been almost same 0.9 and 0.1. However, if you would have invested in March 2017, still you would have made almost a 5 bagger despite of this zero point 0.9 EV to sales. So right now the EV to sales is 0.9. One way to think will be, oh my God, it is almost to the maximum of the lifetime. So, the stock is going to crash. But I can show you one more year when the same value is 0.9 and still somebody has made a 5 bagger. So frankly, I find it very, very difficult to evaluate this company on these kind of standard metric, and especially with cyclic companies, we need to be very, very cautious. And here I'm trying to show you through the data and through the history itself why some of these metrics may not work, which means we need to think in a different way about how to evaluate this company. And then typically, if we think of valuation, what drives valuation of any company? I mean, forgetting about Maithan laws in any cyclic sector, what drives valuation of any company? And the key factors which drive valuation, in my opinion, is the growth of a company, the market size opportunity, the quality of growth and earnings in terms of return on capital. And we have a course where we try to, identify what drives, valuation, what drives companies, and you'll see some of this metrics there. If there is a possibility of operating leverage, which means when we talk of growth, it is more top line, but the bottom line, and if there is operating leverage possibility, many times the growth might look depressed, the PE might look high, or the valuation might look high. But when operating leverage plays out, then it all looks real and possible. And then the earnings visibility and consistency. And here the focus is more on how certain and how consistent these are, like let's say a FMCG kind of business versus a non-linear kind of business. And then there are other qualitative factors like what is the total count of risk levers, what is the kind of stress and the sensitivity on earnings these kind of risks create, what is the perception of the sector, what is the perception of the company, what is the fund flow, how much is regulation risk, how much is the float, and all said and done, it looks good to say that only earnings drives valuation in long run. But we really need to ask what is a long run. I mean, for many of us, a long run might be 1 to 2 years, and even in a 1 to 2 year time, there could be factors apart from earnings which can drive valuation in terms of float and money flow. And maybe in some other video, I will try to discuss this. And then above all, what is the management premium in terms of its integrity and ability to execute? So because looks like, the typical rules of cyclical doesn't work in valuation. And also in cyclic industry, you will see the companies, they don't make profit for certain year. But if you see Maithan Lois, I think in last few years, the worst of the cycle also it made profit where other competitive companies make losses. So should we even consider it as a cyclic company? And considering all that, I just thought let's keep the word cyclic aside and let's try to understand what drives valuation, and then let's try to evaluate Maithan on all these parameters. Now, when we talk of growth, and again, whenever we discuss about growth, we simply project a revenue growth and 10% CAGR, 20% CAGR. But let us go a little deeper. Let us try to understand what drives growth for a company. And when we think of Maithan, I have tried to collect some operational data in terms of its production capacity and how much it is producing, how much it is selling, what is the revenue it has generated. And hence, in terms of operational KPI, which is revenue per metric ton in terms of rupees, what is the revenue per metric ton it is generating, so that we try to understand the pricing power of the company. So the growth could come in two ways. The growth could come by producing more, or the growth could come by charging more for the same quantity. So one aspect of growth is volume growth, and another aspect of growth is pricing growth. So it would be interesting to see how Maithan's revenue has grown in terms of volume growth and in terms of pricing growth. And then in terms of expense with respect to growth in revenue, how the expenses have grown, how the raw material prices have grown. And I've tried to put 14 years of data and then do a 1 year, 3 year, 5 year, 10 year, 14 year CAGR. And what you see here is 14-year production growth, which says Maithan has been able to grow its production by almost 12% CAGR on a 14-year basis. And the capacity has grown at 8% CAGR, which has ultimately resulted in a 18.4% revenue growth. So how the revenue growth has happened 18.4%, there's something interesting. If you see the revenue per metric ton, which is derived by your revenue divided by the production, and that is where you get this number. If you'll see the CAGR of this number, which says the pricing, in terms of pricing on a per metric ton basis, the revenue per metric ton number has grown at 5.9%. So, in a crude way, when you add this 11.8% volume growth and the 6% pricing growth, you get the 18% overall revenue growth, where we can say the revenue has grown 12% by volume and 6% by pricing, which is like 2%, 2 times volume growth, 1 times pricing growth, and that is how you get overall 18% growth. And this is what I have tried to summarize. And if we see the expense growth has been almost in line with revenue growth, whereas the non-raw material price growth have been lesser, which means the core raw material growth would have been little higher, and they're able to finally manage. And the difference between the top line growth and expense growth is almost no difference, and hence kind of on a long-term basis some kind of sustainable margin has been maintained. But on a long-term basis, because if you see the same thing on a 10-year basis, 5-year basis, 3-year basis, the difference is huge. And in fact, if you go on a 3-year basis, the same growth is minus 5%. So, plus 18%, minus 5%, and on a 1-year basis, minus 11%, even though, there is a COVID year. But what I want to highlight is look at the cyclicity of the business. Even on a 5-year basis, the growth has been 7%. One can argue it is continuously declining, but let us see how the next few years are. And one interesting thing is there, if you see on a 5-year CAGR basis, your overall revenue growth is 7.1% and your metric ton growth is also around similar, and your production volume has declined a little bit. So most of the growth has come by pricing rather than volume expansion, and that will get reflected. If you see the capacity of Maithan, it has not at all improved its capacity. It has more or less remained the same. So Maithan has grown more by the pricing, maybe what they claim in terms of creating value-added product. That is how it has grown rather than volume. So the question is, why Maithan is not trying to grow in terms of volume? Is the market saturated by volume, or there are cyclic reasons and they're waiting for the right time to grow in terms of volume? And that is what I have highlighted here. And if you see the consumption data of the whole Indian steel industry, because the growth of Maithan is dependent on domestic steel industry, the CAGR of last 4 years, and I have taken FY16 to 20. If you take FY21, the numbers will look bad because of COVID. They will look somewhere around 3%. So if we can compare it on a like-to-like basis, maybe 3 to 5% of growth, and Maithan has done almost a 7.8% growth. But on a 3-year basis, it doesn't look good. Which means Maithan has also, the industry has also not done as good as projected, because the projected growth was 7%, where they are doing somewhere between 3 to 5%. And Maithan is also doing somewhere between that only if you look from a 3 to 5-year angle. Where the final insight on the growth is, given last few years have been toughest in terms of volume for Maithan, but not still Maithan has been able to derive some growth in terms of pricing. And in cyclic industry, looking at 1 year, especially when we have COVID and all, may not make sense. So still it looks like, at least, in a cyclic industry itself, if a company can grow on pricing, there's some pricing power, or there's some kind of value addition activity they are doing. And given the kind of industry, the way industry is growing and his history and all, and considering that because they have not expanded the capacity, there could be a possibility of volume growth, and it may not beat the industry like 3x time, 7% versus 18%. Still looks like either a either a high single digit or maybe a low double digit kind of growth might be possible. And in terms of market size opportunity analysis, if we try to do, it looks like Maithan, it's not a very saturated market. One, the overall market is growing in a mid-single digit, and second, the share of Maithan in India itself, it has almost 10% market share. So if they can work efficiently and if competitors are not that efficient, opportunities come, it can grow its market share. And actually, it has grown its market share in last 10 years. We have shown in earlier videos, and it can further grow its market share. And these are the various statistics just to provide the market size opportunity, which says there's some kind of mid-single digit market size opportunity, and Maithan could further gain market share, and hence market size opportunity is not something which should be a big worry. Though this growth opportunity is not very high, and this is not linear; it is very non-linear. And again, we have seen the example of how the domestic industry is growing last 4 years. Now we have fair idea about growth. We have idea about market size opportunity. Let us see what is the right margin, because in cyclic industry, the basic question is what is the margin. And even if you do a P, if the margin can go from 5% to 15% and 15% to 5%, the question is what is the EPS you are considering at what margin? So the idea is if we can find a normalized margin, and again I have gone back in history of 14 years, and I have tried to do 1 year, 3 year, 5 year, 10 year, 14 year analysis, and see what has been the average margin, what has been the max margin, what has been the minimum margin at a raw material level, at a power cost level. And why I've taken a raw material and power cost, because these are the two major expense items. And once we have grip over what is going to be the sustainable cost of goods sold percentage of sales, or power cost as a percentage of sales, or what is the percentage EBITDA at a sustainable normalized level, we will in a better position to say, if not from short term, at least from long term, what is the kind of profit and cash flow we can expect Maithan to generate. And if we see one thing is there, raw material cost as a percentage of sales is already touching its, the most favorable scenario. Because if you see right now in 2021, the COGS percentage was 51.9, 52%. Previous year it was 58%. And just if you go to 2017, when the price touched 1,000 rupee and the profit hit the peak, it was at 47%. So I hope you get a sense of volatility, and that is why the max and min is there. And when you average it out, it looks like 58 to 60% is the normalized cost of goods sold as a percentage of sales, and the current value is 52%. Now we don't know how much of this is possible through value-added products, which is sustainable, and how much is because of cyclicity of raw material. But for sure, there looks like a risk on the raw material price. Maybe it can come down again to 47%, but it is still far from the sustainable level, and hence the risk reward is not that favorable. If we see the power cost, the current power cost is around 20% of sales, and the normalized long-term average power cost is also similar, which means it may not go, be favorable, but it may not be unfavorable also. But given this, now we get a fair sense of if we are trying to find the sustainable long-term profit, keeping the cyclicity aside, these are the kind of margins we can consider in terms of cost of goods sold and power cost, which finally gives us a EBIT margin which is more sustainable. And even though the company sometimes does a 20% EBIT margin, sometimes it does a 7% EBIT margin, a 13% kind of number looks much more sustainable on a long-term normalized basis. And these are the numbers we will consider when we will try to value the company. And there is a rationale how we have tried to derive how to value the company, and why we should take those assumption numbers, and there is a data driven logic to establish rationale for taking those numbers. The third thing is, whenever they do a expansion, it's a cyclic industry, are they going to generate same kind of ROCE in future what they have generated in past? And actually 2 years back, they came up with some kind of greenfield plan, and this was the overall estimate, though they could not execute it because of changing market dynamics and all. But this looked like a good return on investment of 29. And that could be one reason why they have been slow in volume growth, because they don't want to grow just for the sake of growing. And again, when you go back to our part one video, you would have seen many examples in the annual report where they focus on the quality of growth rather than just merely growing. So with this, it gives some confidence that even future growth will have decent ROCE. So now if we look back to the all the parameters of valuation which we thought through, growth and market share, return on capital, we have tried to highlight what could be the possible scenarios. So high single to low double digit growth rate on a 5 to 10 year long-term CAGR basis with short-term hiccups is possible. Market size is favorable for those who can gain market share. Maithan has been gaining market share. Return on capital has been efficient, and based on the current expansion plan, also it looked at historical track record. This looks decent. Management premium, they have executed it well since 2008. If you look at in terms of their capacity growth, in terms of the market share capture, there has been no serious hanky-panky. The related party transaction data, everything looks okay. There are no bad minority shareholder treatment and all. In terms of risk lever visibility consistency, this looks poor because it is in cyclic industry. There is a cyclicity risk. There is too much volatility in price. There is volatility in earnings. The visibility is very difficult to predict when, if the next 1 year will be good or it will be bad, because, you have seen the kind of metric ton prices change, the way demand changes, the way raw material prices changes, the way power cost changes. So consistency and visibility is something which is missing from this company. And the last is perception, the fund float. These are other factors. I don't know how many of you know about all these things. And basically, fund flow is are there big parties buying, and float is about what is the percentage of share open to trade in the market. And perception is finally what is the image of the company and the promoter. And actually, the company has been holding on a lot of cash, and they have tried to justify it because they're in cyclic industry. They want to, be in the strong position when the opportunity hits, and they want to go with a strong balance sheet, so they don't think of 1 year 2 year. But ultimately a lot of cash has been lying on the book, and that has created a perception if the books are right, wrong, all of that. There have been few family issues also which has related some kind of corporate governance issue. There is not much of mutual fund participation, and a lot of this creates some kind of, if not positive, if not negative, at least not a positive perception. And not being a cyclic industry, at least I haven't seen the company being darling of mutual funds despite of the numbers being really good. And float wise, it looks good because promoter is all the maximum stake in the game with 75% stake. So if with all of this, we try to do a DCF kind of valuation, I know it's a cyclic industry, but then again, the company is not making losses. And if you see the cash flow, OCF, FCF, everything, even the worst year looks decent. So I've taken all these numbers, the kind of growth rate possibility with strong data-driven backup of the rational, the sustainable PAT margin, where you saw the EBIT margin is 13%, and then there's no interest, so only thing is tax, and they can operate on 25% tax, but there are certain tax advantages. They operate around 20%, but still I have given some benefit of doubt, and from 13% you reduce 3%, and you consider a your 13% to 3%, you reduce that 25% taxation, and you get your 10% PAT margin. And then based on the history, the CFO to PAT conversion, the maintenance capex, taking all these estimates, the stock looks like fairly valued right now. And the thing is, all the numbers are assumption numbers with the logic, but these numbers can change, being a cyclic business, or nobody knows the future. The next few years might be very good. So when all these numbers change, also the perception changes and the valuation changes. Also in the short run, sometimes prices have nothing to do with fundamental. I mean, if there's a very strong party which holds 5-10% stakes and they're selling, and there's not enough buyer, the price can keep on falling, and the reverse is possible. So all sorts of things can happen, and in 1 to 2 years, it's very, very difficult to, give a, say if this value is going to work. That is how, but that is how the valuation is, and I have tried to give a framework and a perspective on the same. So what we can do is we can also look at the technical analysis.
Hello friends, welcome to Scientific Investing and welcome to the course Introducing Fundamental Analysis. In this course, you will learn about how to understand sectors and company financials, operations, management, how to do market size opportunity analysis, how to find fraud patterns, how to do valuation of these companies in order to identify high performing companies and avoid the loss making companies. This will help us in making better financial decisions. Also, we will use a lot of analysis checklists, templates, dashboards, and analysis tools. And we will leverage some of these tools to make better investing decisions where we can go into Indian stock market history. We can look at last 20 years of data and we can perform various analysis to understand how these companies have done and what makes some company a good company, what makes a bad company. So all this you will get in this course. And finally, you will be able to make better investing decisions by knowing what to buy, when to buy, how to buy, and the same thing in terms of how to take your sell decisions. Also, you will learn about your capital allocation and risk reward. And what you get in this course is you get pre-recorded video lectures, which you can watch as per your convenience. You get access to a LMS platform for all these video lectures as well as PPTs. You get a lot of templates and Excel tools to perform your analysis. And you get a fortnight Q&A hand-holding session to clear your doubts. So welcome to the course. Looking forward to have you. Thank you.
Now, why we look at technical analysis is because these kind of cyclic industries, they are very uncertain. So taking a DCF kind of approach many times may not work for the simple reason that the assumption numbers which we are taking, because of uncertainty, we don't know. We don't know when the big growth will come, and when we don't know when the big growth will go off. And that is where sometimes technicals, they come to rescue, where it's the industry people who have better visibility, and what they are doing based on that, as a technical analyst, we try to hop on and we try to get a visibility into a future which we may not have seen as a fundamental guide. And I have tried to put three types of time frame chart: monthly chart, weekly chart, and a daily chart. And if again, I will not discuss into like how and why, but if technicals, you can get a feel of these charts. So I can see there is an encouraging bullish accumulation pattern. And basically, if you see the accumulation which is happening, it's happening in the form of this kind of, you can call it a Loteka Pendi or a semicircular thing, where before this there was a huge accumulation, and then the distribution happened, and then the bottom got created, and this same bottom acted as support again, and then some accumulation is happening, and again the volumes are building and the RSI is increasing. So it looks like the company is in accumulation phase. After a long time, the monthly RSI has been above 50. And look at the last bull run. Before that, there was a correction, and the RSI could never cross 50. Even though it tried, it couldn't cross 50. And then a bull run came when the RSI created a bottom, and then the bull run came. And in that bull run, once the RSI crossed 50, even in the correction, if you see, the correction happened, and the best correction and the worst correction, it got support at 50, and then again it went. And during the whole bull run phase, it remained above 50. And then when the correction happened, again the RSI came below 50. And then it struggled to cross that 50, and that has been happening for last 3.5 years. And then after a long time, again, that has crossed that 50 RSI resistance. And then even during the last correction, which has happened, this may not look like a big correction, but we'll see the daily chart. But still, it has maintained that 50 RSI above level at a monthly chart level. And the volumes are growing, the accumulation is happening, it looks like, and it might touch that 1,000. 1,000 is the next big resistance. Right now, the stock is around 770 levels. If we look at the weekly chart, few more points. So if you see the weekly chart, you can see there is a typical uptrend with higher highs and higher lows, which is a typical, bullish uptrend pattern, and which is supported by volume, where the uptrend higher high, when the stock is making highs, there are big volume green bars, and when the stock is correcting, the red bars are of very low height, which says there is nothing to worry, and the RSI is also in the positive direction. And again, the RSI, weekly RSI is also above 50, and almost it is maintaining that 50 level. And when we see the daily chart, at a daily chart level, what is interesting is, even though stock had correction in last 1.5 years, and one correction was very recent, the stock got its support around 200-day moving average. And 700 is a key, used to be a key resistance level. This was a key resistance level which has got crossed recently, and the stock went above 800. Again, it is correcting around 770, but looks like because this has been almost 2-3 year old resistance twice, even if it corrects further, I'm hoping some support to come here, until unless the fundamentals completely change and the stock crashes. So with all of this, now let's get into the risk analysis of a company, because more than the opportunities, it is more better to know about the risk, because the buy is easy, sell is difficult, and if we are aware of the risk, we are much more better prepared to manage the sell and also buy with margin of safety. So what we have done is, when we think of risk, there are two parts to risk. One is the likelihood of risk, how likely this risk is supposed to occur. And let us say if this risk occurs, what is the kind of impact this risk will have? And if we have a lot of high likelihood, high impact risk levers, then that is something to get really caution. So what I have tried to do, I have tried to identify the risks and put it on the likelihood and impact metric on a 3x3 metric. And the most important risk is commodity-based cyclic risk, both in terms of product price, demand, raw material price, oversupply, all of that. Second, there is a humongous dependence on steel sector, and if by any chance steel sector goes for a toss, for sure the company is also going to suffer. The other high likelihood risk is because it's a cyclic investment, it's not a buy and forget kind of investment. We need to always be cautious about the valuation. And we have seen some of the big investors also not selling at the right time in cyclic sector. And I mean, it's good to say I'm a long-term investor, but if you can time the market to a certain extent, why do you want to let the returns go? But despite of that, if you see historically the kind of CAGR this company has generated, it has been a very good investment. One reason could be because the valuations itself were very depressed initially, and those valuations may not come. But still, the returns not on a 1 year, 3 year basis, but if you go a little longer, like full cycle, 7, 8 year basis, and if you are able to time it by not getting at the peak of the cycle, still the returns have been decent, and that is why I have put the impact medium, not high. Some of the other risks which are there, I consider low likelihood and low impact is insufficient use of cash, because it looks neat and clean, and there are certain companies where the money was parked, everything looks okay. So I don't see anything bad happening there. There is another risk which is low likelihood, but the impact could be medium, high revenue concentration to few customers like sale and all, where they have a high single digit, revenue concentration. Now, I don't think why sale will jump, because they are the lowest cost producer. So until the sale finds another lowest cost producer, which looks like very difficult because they have been able to do it, I don't see a reason why sale should, switch. Maybe sale can do it in a captive way, but again, being a government company, I think that my view is they cannot match the kind of financial efficiency Maithan has. And given how PSU companies have pressure to be more efficient, the chances are less likely, and hence low and medium impact. Chances of fraud and poor treatment to minority shareholder. This is because of all the noise which goes on high cash on books, or there were some of the family members who are like more in terms of cousins and all, were named in some fraud activities, and hence I have marked it as a high impact, though chances are low, because at least the promoters who are running, they are separate from the cousins. And 2 3 years back, there was before all this issue happened, the whole shareholding transfer happened, where many of these promoters transferred their share, they exited. And even if you were there, they were there in terms of non-promoter capacity, they were holding 1 or 2% stake. So apart from this, maybe that was a precursor for management and the actual promoters to just separate themselves, and maybe that is why it happened. Nobody knows, because the company doesn't do con calls and all. But in last 10 years, apart from that, there is no other data. I mean, if a company has to do fraud or cheat minority shareholders, they can do in n number of ways, and everything looks very clean in terms of balance sheet, subsidiary structure. So I feel the chances are low, but yeah, if it happens, there could be a high impact. The other thing is domestic and international competition. So even though the Indian steel sector is going, there could be import, and import could kill the market. So it's a global supply chain and global demand supply and all those kind of risks. And our own ability itself to time the stock, because there's not an easy sector to time, and it's not easy to value these kind of companies. So somewhere I think this is also a risk, and one we can mitigate by timing it properly. You will have a better risk reward ratio. So by this we cover the risk. So finally summarizing everything, If we build a mental map of the company, key opportunity, key risks, it's a efficient, low cost player. It has a very strong balance sheet. It has the asset light model. It has the ability to execute and gain market share. But on the risk side, this is a cyclic industry. There is a steel sector dependence. There is a little bit of client concentration dependence, and there could be a risk of insufficient use of cash because they have been sitting in the cash for a long time. And so far, they kept telling, but still they're holding the cash without, off late they have come up the greenfield expansion plan, but they came with one plan again 2 years back. So we need to wait and watch and see. So that is how I would like to summarize the stock. And I hope you got a perspective into how to think about companies, how to think about business models, how to think about cyclic versus non-cyclic companies, how to think about valuation, why these standard valuations may or may not make sense, how to go a little deeper and how to connect the financial data and operational data, how to think about risk. So I believe this is one use case which would have given you a lot of different perspective on these different angles when you try to evaluate the company. And also, when to even dump some, not dump, but sometimes look beyond fundamentals, and that is how when and where some of the other skills also come into picture which can add value. So with that, we will end. Thanks for your time, and I hope it was worth your time. I'll see you again with some interesting videos on the YouTube channel. Thanks for your time. And if you like our channel, do subscribe to our channel, do spread the positive words. If you have any negative feedback, don't hesitate. The comment section is open. Feel free to put all the feedback, positive or negative, and we will take it in the right spirit. Stay safe, and yeah, thanks for your time.